Now friends, I'm starting with one of the very important topic of transfer pricing in your international taxation. Friends, before I go ahead, let me tell you that this particular topic is extremely important from your examination point of view and also from your real life point of view. Friends, if your intention in life is to practice international taxation, and let me just tell you, not just whether you want to practice in India or whether you want to take a job abroad, and abroad also if you want to venture into international taxation, this topic will be extremely important, extremely important. In other words, friends, this topic is such a versatile topic that the concept of this particular topic is adopted by practically almost every country in the world. However, the language of law that we have in India may not be the same language of law in your foreign country law, but the ultimate concept that we are going to learn with the help of this particular chapter will be applicable almost in every country. If you practice in your life the international taxation, every day, every minute, you will have to deal with this particular topic. This is a hardcore topic for everybody who is doing international business. So anybody which is into international business will always face this particular chapter and will have to face this particular chapter not only in India but in almost every country of the world. So hardcore basic things also, you may feel that, oh, it's so simple. I mean, it may be so simple, but you got to understand it with reference to the real intention of the law, and you need to understand particularly how this particular chapter has been actually applied to the given circumstances and what is the ultimate outcome on the tax liability front, and is there any penalties etc. which are associated with this. All these things, friends, you got to learn it very, very carefully. Okay, friends, transfer pricing is a topic to begin with. Let me give you a brief introduction. Let me give you a very, very brief introduction of this particular topic, and let me explain to you, friends, something which is, what should I say, very, very basics and very, very simple thing on the face of it. Okay. First of all, friends, understand what is a transfer pricing. See, in the international trade, in the international business, every government is going to tax. So if you have profit in the country, I repeat, if you have a profit in the country, then that particular government is going to tax it. Fundamentally, friends, in the economics, not in the taxation, but in the economics, there are two types of sentiments of the government. I repeat, there are two types of sentiments of the government. One is what we call it as a profit center. Other is something which is called as a cost center. I repeat, internationally, friends, at the government level, I'm telling you how the governments actually think and how the governments try to talk about taxation in the international trade. There are two types of fundamental sentiments of the government in the international situation. One is profit center, other is cost center. Okay, what is that? See, one type of government which is something like a China. So what the Chinese government think? The Chinese government think that we want to become the factory of the world. I mean, see, what they think is that all the international products, whether it is hardware, whether it is software, whether it is cosmetics, whether it is something to do with the fashion or your day-to-day things, your food, whatever industry, the government thinks like that we want our country to be a hub of production. That means they want manufacturing activity to be boosted in their country, in their economy. And the perfect example is China. So in China, maximum corporates will be incurring the cost. Okay. But then the Chinese government, see, you keep on producing. So your economy may not be able to consume so much. So ultimately, all this production that you do in your country, you want to export it. That means you want to sell it. Okay. So there has to be some consumers which should be willing to buy that particular product, and maybe those consumers are in a different country. So you want to sell your product. So you have produced in China, but you want to sell your product somewhere, and the place where you sell it, that particular country and that particular place is the place which is called as a profit center, because the place where you sell the goods, that is the place where the profits accrue. See, for example, if you purchase one product from India, but you sell that particular product, say for example in Japan, for example. So this particular place, the country where you are selling that particular goods, that government will think that, look, you have sold your goods to our customers. That means customers are in that particular foreign country. Supposing if I am selling it in Japan, so Japanese government will say that, look, you are selling your goods to your Japanese customers. So ultimately you have sold your goods in Japan, and because you have sold your goods in Japan, you have made profits from Japan, and so the Japanese government wants to tax that particular profits. And the perfect example of a profit center in the international business is something like US. If you see any app products, any latest products, if you want to see, for example, mobile, which nowadays we all of us are so much used to. For example, the latest iPhone comes, latest Android phone comes, which is very expensive, 50,000, 60,000, 80,000, 1 lakh rupees phone also, which keep coming out. Okay. Now, we Indian customers, we think 2 times, oh my God, such an expensive mobile. Oh, we will think 2 times. So, should we buy it? Should we wait? Should we wait for the price drop or something like that? But American customers, the American consumers don't think that way. They want the latest thing because they want to be into fashion. So, the latest phone will come. For example, immediately the first shipment will go to America. The first launch of that particular product will be in America. Why? Because the American customers, the American consumers respond to it quickly and they buy it. So what does the American government think? The American government will think that because you are selling the product in America, you pay taxes in America. And the American government will think that because you have made profits in America, because you have made profits in America, you have sold your goods in America, you pay tax in America. So American government will think like that. Our source of revenue, listen very carefully, our source of revenue is going to be maximum from taxes. This is how the American government may think. What the Chinese government will think? The Chinese government will think that because our maximum production happens in China, our economy, our jobs, our Chinese population will be much more better off because they will have a job security, they will have better life, they will not have to struggle because they will have day in and day out manufacturing activity. So their economy will keep moving out because everybody is working hard. Is that very much clear? Now, let me take this issue forward. Say, for example, there is a foreign company. India, supposing a foreign company sells its goods to someone in India. Just very, very simple thing, okay? So, this foreign company is selling goods to somebody in India. Now, you imagine, no, our Indian economy is mostly import oriented. We always want to promote our exports, but always our imports are more than the exports. Now you think about any good product. For example, your day in and day out mobile phone that you are using. Most of the mobile phones are manufactured in China, but they are imported to India, and then we consumers, we buy them, and ultimately those corporates make profits. So what this Chinese mobile phone, these Chinese mobile phones are sold in India. Very simple example. You can take the example of any international brand. For example, you take it as a Reebok shoes. You take it as a Nike shoes. Okay. So you see nowadays, most of your generation people, the college students, they love to wear these fashionable shoes. So how that shoes have come to India? So ultimately it's an international product. So it is imported to India and then it is sold to the Indian customers. So logically, friends, the Indian government should think that this sale is to your Indian customers. So you should pay tax in India. Indian government will think like that because you are making profits by selling your goods in India. Is that clear? So let's take up an example. This particular foreign company has got a cost of, say for example, 20. The selling price is, say for example, 60. The profit is 40. This is a foreign company profit. Just hardcore basic example I'm taking, okay? Don't confuse yourself in any case, and don't think about any law right now. This is a common sense which I'm trying to explain that to you. Now, Indian government, now these goods are imported in India, so naturally your cost is going to be this price. Well, that is the price at which it is already imported. Okay. Then it is sold in India, say for example for 130. You pay tax in India, so you make profits in India and you pay tax in India. The difference is, this difference is your profit, and Indian government will think that you should pay tax on 70. So on 70, whatever the profit comes, whatever as per the Indian law, you should pay taxes in India. Hardcore simple thing. Okay. However, now the Indian government will think little bit more also. The Indian government will think that this foreign company, listen very carefully, this foreign company has sold its product in India. Listen very carefully. So this profit of 40, probably somehow or the other should also be taxed in India. They will think like that. Indian government will think like that. The reason being that you have manufactured some product in that foreign country. Say for example, you have manufactured that particular product in China, and that you have sold. So this particular sale and this particular cost is just a price at which the goods are moving into India. This is probably maybe the invoice for the purpose of customs, for example, because the goods are imported in India. But that profit, that particular quantity which has been sold in India to the ultimate consumer in India, that also you pay some taxes in India. The reason being that your ultimate goods are sold in India. But it may not be so simple in the international taxation. But Indian government will think like that, that the ultimately whatever that quantity is sold in India, you pay taxes in India. But it doesn't work out so simply. Every government will think like that, but it will not happen so simply, because then people will do a lot of these, that and kind of transactions. Okay. So Indian government will think like that, probably. Okay. That particular foreign government will also think, that it should be taxed in their country, because ultimately you are a taxpayer of that country. So basically, because you are resident of that country, you pay taxes in that country is also a possibility. So these kind of situations will keep on coming in between the two governments, and somehow or the other there has to be some sort of a way out for the ultimate taxation. Now, because there is a complication, listen very carefully. Now this particular foreign company will do a tax planning. So this is a foreign company. Because foreign company will say that, oh my God, we pay taxes in foreign country, plus we pay taxes in India, plus we pay taxes in on the local sales in India. So basically foreign company will think that, oh, we are paying a lot of taxes. So that's going to be complicated. So we want to do some planning. So what kind of a planning that these guys will do? Okay. Now this foreign company, listen very carefully. I will take up the same data. 20 and 60. So your cost is, your P&L is, cost is 20, sale price is 60, profit is 40. This is our profit. Okay. Now you are selling it ultimately in India to the Indian customers. Okay. But now what you will do is, you will not sell, because here, earlier when I told you, I sold goods in India. So it was a very damn simple transaction. This is the transaction that the foreign company is selling. But in real life, you will never find such a transaction. In real life, friends, you will never ever find this kind of a straightforward, plain vanilla kind of a transaction. Okay. So what this particular company will do, listen very carefully. It will have some another company in some another country. We call it as a country number 2. Maybe in that particular country number 2, there will be another foreign company, and maybe that particular country will be something like a tax haven, or there may be some other advantages. So somebody call it as free port also. In other words, there can be certain countries in the world where those government make their country as a tax haven. Those countries will say that there will be no taxes in that particular country, or even if there are taxes, there will be a very minimal taxes, very small amount of taxes you pay, and you can do big business in that particular country. And there may be a lot of other advantages, like for example, there may be benefit with respect to the corporate law. Now, for example, Switzerland once upon a time was very famous because of its banking laws. In fact, the Switzerland was not a tax haven, but it was a very big haven, keeping in mind their banking laws. I'm telling you years back that if you have an account in a Swiss bank, the Swiss bank will not disclose the identity of the account holder to anybody in the world. Once upon a time, I'm telling, that is also kind of a heaven. So there can be variety of the tax havens, keeping in mind different law. Some of the countries are tax havens, like for example, they are havens from corporate law point of view. For example, so those countries, their corporate law is so beautifully styled that they will not disclose anybody's identity. For example, who are the directors of those companies in that particular country, of that company, you will never know. The government will never disclose. For example, the list of shareholders in that particular country. So there is a company in that particular country, the list of shareholders will always be kept secret. Nobody will have to disclose it. So for example, if I want to keep one Benami company, for example, so what I will do is, forget about my tax situation. I want to park my money somewhere. So I will look for such a country where I will float a company in which I will be maybe, or my group of people will be shareholders. I'll be the director, but my name will not go anywhere in the world. Then I will do a lot of transactions through that particular country because I want to keep my name a secret. Now, for example, a big politician, he wants to move a lot of money internationally. How can he move that? So he will be routing his money from that country where the corporate law is very friendly. He'll be willing to pay taxes. He will say that I don't mind paying taxes in that particular country, but my name should not come anywhere in the world. So there are many more types of different categories of heavens, different free port, depending upon your requirement. So international experts will tell you that, oh, if this is a requirement, then this is the best country. Something like that. So what this particular foreign company will do, it will float some company or some corporate entity. Logically, the corporate entity, it cannot be, it can even be a non-corporate entity in some heavens, maybe tax havens or maybe free port, whatever you want to call it as, and it will route the transactions through that particular free port. So what it will do, it will move the shipment to that particular country. So there the cost will be booked. From that particular country, the goods will move into India. So selling price is, say for example, 100. Okay. So there will be a profit of 40 in that particular country. Okay, so say for example, I take it as 110 because then this 40 and that 40 is matching, no? So let's say that selling price is 110 and profit is 50. Now in India, the cost will come as 110 because this is the price which is moving in India in the international trade. Then there will be a selling price, say for example 130, and there will be a profit in India which is 20. So ultimately, friends, in this particular transaction, what has happened? Just imagine, in this particular situation, previously your profit in India was 70. Okay, and profit in that particular country was 40. Listen very carefully. That was the situation. In fact, that foreign country was also taxing 40. Maybe Indian government may also think about whether you should tax, not tax or something like that. So tax on 40 you were to pay in foreign country, maybe in India, you don't know, that it can give rise to some double taxations. Okay. And this particular 70 is also been taxed in India. So totally there was logically the profit of 110 between two countries. Now the same profit of 110 has been divided into profit in one country, that is your original country, then your profit in a free port, and your profit in India. It is same 110, but it is somehow or the other divided into three countries. Such that some profit has gone to the tax havens. Okay. And on this particular 50, logically, there will be no tax or there will be a minimum tax. So ultimately, Indian government will now get pinched. Indian government will say that, oh my God, we have got a profit of just 20 for the purpose of taxation. That means the Indian taxable profits have been just 20, which is basically manipulated profit. This is how the Indian government will think. And therefore, they want to apply the concept of transfer pricing and they want to tax some more money beyond this particular 20. So what does the Indian government think? The Indian government now thinks that, look, in foreign country, what you are doing, it's not in the hands of the Indian government. Now, for example, if somebody is in America, somebody is in London, somebody is in some European countries. Now, there you are moving goods from one country to another country to third country, fourth country. Nobody knows that. I mean, everybody can do that particular transaction. Indian tax officers will never know that. So, Indian tax officer practically will not know that how these international trades moving from one country to two country, three country, four country. And I gave you example of one country to second country and then India. However, these particular goods can move from one country to second country to third country to fourth country and fifth country may be in India. You don't know. So it can be very, very complicated kind of situation. So what Indian government will think, Indian government will say like that. Okay. Look at this particular point of cost. So Indian government will target this particular figure. The Indian government will say that these 110, which you are showing to the Indian government, because data available to the Indian government is a cost of 110. This selling price is to the Indian customer. That's probably the very genuine selling price. So we have not to question this particular selling price in the given example because it is sold to Indian customer. So Indian government already knows what is the sale price of this particular goods. It's already known to the government. Now the cost 110. Now Indian government will put a finger on that. Indian government will say that, look at this. You have incurred a cost. You are showing that this is a cost. Basically, it's imported goods. So, you are showing that this particular goods imported to India at an amount of 110 per unit. Say, for example. So, Indian government will say, is this genuine? They'll put a question mark here. The law will put, the Indian government, that means the Indian law will put a question mark saying that you are saying that the cost is 110. Is this a genuine cost? And there, the transfer pricing concept and transfer pricing law straight away comes into picture. So, for example, now you will say that a mobile phone sold in India, for example. Okay. So, what is the fair cost of that mobile phone? This is how the discussion starts. And moment there comes a question mark on this particular cost in the given transaction, government will involve a lot of machineries, then the government will involve the technical people, some valuation officers, and they will think, and they'll be experts in the international trade, they'll be experts in the knowledge of international valuations, and they will say that the fair cost of these particular goods cannot be 110, but it probably can be something else. And the transfer pricing starts immediately. So now probably the Indian government will not care about what you did in country 2, what you did in this particular country, will not look at all these numbers, probably. But the background of everything is, the Indian officer will simply say, Indian tax officer will simply say, from what country coming, this, that. I don't know, because there can be hundreds kinds of manipulations. So I don't want to go into that ifs and buts and original. Just tell me whether the cost that you are showing to the Indian law, 110, is it genuine? Is it fair? And that question immediately focuses on the transfer pricing. And say for example, moment the doubt comes whether this particular cost is genuine or not genuine, something called as a fair concept, that means valuation concepts will come into picture. Government will do process in this particular chapter, and say for example, the fair cost is, say for example, just 60 rupees, say for example. But I don't want to use the 60 because this 60 you will confuse. You will say that, oh, this is the 60 from where the sir has got the number. Let me take up some any odd number, say for example 63. So you don't have to look at this 20, 40, 60, this 60, 50, 100. All these numbers are just illustrative numbers which I just showed it to you. but exact numbers will not match ever in this particular chapter. But in the background of the science, this is the background of the science I'm telling you, the Indian government will think, Indian tax officers will think that now the cost which you are showing me as 110, is this cost a fair cost? That's a question mark. And there from the transfer pricing starts. And let us assume for the timing that supposing that the fair cost as per this particular chapter, supposing is 63 rupees. And this is what we call as the valuation. Transfer pricing is basically called as a science of valuations. So this is 63, okay. So this difference, listen very carefully. This difference between 110 and 63. So what government will say that your actual cost, which is 110, will not be accepted for the assessment, but we will accept only 63 as the cost of that particular goods. So difference, in other words, you have done overbooking of the cost in India. That's the reason this particular profit was a suppressed figure. So instead of cost being taken as 110, logically the cost will be adopted as 63, and logically the difference between the fair cost, and the actual cost, whatever is the difference, so 47 rupees be the difference, this difference, okay, this will be your transfer pricing income chargeable to tax in India. Hardcore basics, friends, hardcore basics. Okay, so how does the Indian law will do the computation? How does the Indian law will do the computation? That also you understand. So now your assessee in India is going to be this particular assessee in India. Okay, you will say that you have a total income. We will do that normal computation, heads of income or something like that. So total income will be 20. This will be your total income. Total income is actually as per your official records in India, your profit based on the purchase, sales and all other transactions, etc. Okay, so this particular is your total income. To this we are going to add the transfer pricing income. This is how the computation will be done. Listen very carefully. And this will be your computed income, total income after your transfer pricing adjustment. But how will the transfer pricing adjustments will be done? Your actual cost, which is considered to be excessive, that means to that extent you have manipulated the profits. That's nobody will say that, but that's the hardcore understanding of this particular chapter. So basically it's a manipulated cost, it is unfair cost, whatever you want to say. I mean, and your reasonable cost is, say for example 47. From where did you got this 47 number? No, sorry, it is not 47, sorry. The fair cost is 63. Okay, so your fair cost is 63. From where did you get this particular number? This is basically the valuation. Transfer pricing is basically the science of valuation, which says that this transaction is valued as per the process of this particular chapter at this particular amount. So that's a number which is done as per the procedure of this particular chapter. Okay, so the 63 doesn't come from air. You might assume, no, it is not like that. There is a procedure. That procedure will be complied with, and then this particular value will be arrived at. This difference is basically your transfer pricing income, and your total income will get adjusted by this particular amount, and your total income will be computed as like this. Have you understood that? Absolutely. And this adjustment is a transfer pricing chapter. Okay. However, extra points that you should keep it in your back memory, and always you should keep it in your back memory. Okay. On this particular income, naturally, because your total income has got adjusted, the amount of the taxes will come. Taxes will have to be paid. So Indian government will get that particular amount of taxes in its kitty. Okay. There can be penalties, because government will think that you have done under overvaluations, etc. with respect to a transaction, so that you can suppress the profits in India, so that logically you are cheating the government in India, logically, but it's like a white collar thing. Okay, so they may impose penalties on this particular transaction is the possibility. Further, this chapter will apply only if it is an international transaction, or if it is a specified domestic transaction. However, this some specified domestic transactions, I will discuss it later, but right now I will focus only on international transaction. So basically it is trying to say that this foreign company and these two people, this transaction, this is a transaction that we are talking about. This transaction should be in the international trade. It should be an international taxation. Okay, so it should be international transaction. Further, it says that it should be between an associated enterprise. In other words, these two companies, in my example, F2 and India, this should be an associated enterprise. Associated enterprise is basically your related party transactions. So, this particular chapter will come into picture only if there is a transaction between related parties. However, related parties is a simple word. In international taxation, they are logically called as associated enterprise. Okay, so there is a special word, there is a special phrase in the international taxation. I will just write in the bracket, logically it is a related party transaction. In other words, if it is not a related party, then this particular chapter can't be applied logically. Okay, this is a related party transactions. Okay, further, one of the person has to be a non-resident. So in my example, this F2 and India, that means one company in India logically. So either of one of the person should be non-resident, and logically it's an indirect way of telling you that this is a international transaction. Okay, and against the transfer pricing income, you get no deductions, or you do not get any section 10 AA etc. benefits. That means against this particular income, you do not get some of the specified incentives which are normally provided in our domestic law. So if you supposing say that your income is 47, against this 47, you do not get the specified deductions or the specified exemptions. Okay, so basically it will give rise to a tax obligations on which the Indian government will get the revenue, saying that this particular money is to be taxed in India. Okay, now I'll give you another way to look at it. Okay, this international transaction, in my particular example, it was an example of a cost. See, listen very carefully. See, the whole example which I had styled for you was basically a cost which you are incurring from the international trade. Okay, that means logically it was a purchase, but it may not always be the same. Okay, in other words, this concept of valuation, this is basically the concept of valuation. This can be applied to the cost, this can be applied to the revenues, this can be applied to the selling price. Now, for example, when the entire example which I gave it to you, the entire example was import oriented example, say for example, but the same concept can also be extended to the export oriented transactions also. So in export oriented transaction, you have to think other way around, keeping in mind the selling price, whether the selling price to that associated enterprise in the international trade, was it a fair or was it unfair? In other words, the concept of international taxation applies to both the types, whether it is a cost, whether it is revenue, whether it is selling price, whether it is some financing transactions, everywhere. In other words, this transaction will be, that means this concept will be applicable if your taxable profits, are being suppressed. That means if there comes the question mark on the taxable profit, logically, that means the profit which you are showing to the government, that means the profit we are showing to Indian tax authorities, is it fair? And that is how you have to think. Okay, so don't just think that it should always be from the cost point of view. It can be any business transactions which affects your taxable profits. Okay, further, I will give you some example. Supposing cost, your actual cost, which you have to compare it with the fair cost. The fair cost in this chapter, in this particular concept, is called as a ALP. ALP is basically arm's length price. I repeat, ALP is called as arm's length price. Basically, it is a fair cost, or it is a fair value of a transaction. Okay, supposing your cost actual is 100, listen very carefully. Okay. So your fair cost is, say for example, 120. Because every transaction which is subjected to international taxation and international transaction and associated enterprise that is related to party, it will be valued, and after value you will get some value, and this value come out to be, say for example, 120. Another, that means what I'm trying to say, that your fair cost is more than the actual cost. Okay. And your fair cost can also be less than the actual cost. So theoretical situations are that your cost, which is actual cost, is 100 and your fair cost, that means your ALP cost, is more than your actual cost, or it can be even less, because when the valuations are done, it is never exactly going to match to 100. Okay, so it can either be more or it can either be less. Okay. Now transfer pricing income. Transfer pricing income is, supposing if your fair cost is lower, that means actual cost you are showing to the government is more, so there will be a transfer pricing income of 30. In other words, what you are showing to the government, this particular figure is an excessive figure. That means you are showing excessive cost to the government logically. So excessive cost means you are suppressing the profits. So ultimately your transfer pricing income will get added because of overvaluation of the cost that you have done. But supposing if your fair cost is 120, then you cannot have a transfer pricing income, rather it will be a transfer pricing loss. Because if you substitute the fair cost, if you supposing logically substitute the fair cost for the actual cost, so your net profit effect is going to decrease. Your profit is going to suppress if you substitute the excessive fair cost. So in that particular case, friends, the law says that this is basically the transfer pricing loss. It is not a transfer pricing income. So the chapter do not apply. This chapter do not apply. In other words, the intention of this particular chapter is only to tax the income. So logically what the law is trying to say, that this actual cost you are showing is a fair cost. That means this is a fair figure. This is not an excessive cost. So lawmaker thinks that, okay, we are happy with this because you are showing reasonable cost to the government. So the transfer pricing loss, this is how can be thought of, is not apply. That means this chapter do not apply if there is a transfer pricing loss. Rather, there is no concept of loss. Basically, the lawmaker says that the cost which you are shown to the government is a fair cost. So we have no objection with that. This is the attitude. Okay. Same thing is, say for example, selling price. Okay. So let us take up an example with respect to the selling price. Okay. Supposing your selling price actually is 100. And your ALP selling price is, say for example, 130. That means your reasonable selling price of a particular good. So this is now export oriented transaction. Is, say for example, 130. Or put it differently, your actual cost is 100. But your reasonable selling price, this is export oriented transaction. Example. But you should not forget the basic thing, that is, it should be international transaction and it should be between the associated enterprise. Okay. So here, if your reasonable selling price should be 130, so what you have done, you have suppressed the selling price, and because you have suppressed the selling price, you have suppressed the profits. The lower selling price means lower profits. So this 30, the difference between 100 and 130, this is going to be a transfer pricing income. But if your fair selling price is 90, for example, so in that case, there is going to be a transfer pricing loss. In other words, this particular is basically the transfer pricing loss which logically comes into picture. Chapter do not apply. Chapter do not apply. In other words, there cannot be the loss adjustment. So you cannot say that give me refund back on account of taxes. That is never the intention of the law whatsoever. Is that absolutely clear? Okay. So this chapter applies only if there is a transfer pricing profits. Okay, that means there is a taxable income. There cannot be losses permitted in this particular chapter. However, friends, this is hardcore basics. When I go still some more deeper into this particular chapter, I will make use of some barrack provisions to give you explanations about all these things, because everything is provided in black and white. See, nothing is logic here now. Moment we dive deeper into the law, then ultimately there is nothing like logic. It is something like straightforward provisions of the law, but the law is a very logical thing. Okay, so ultimate conclusion will come logical only, but everything will be, friends, printed in black and white in the law. Is that absolutely clear? Okay, if you want, you can take down this particular example, friends, of cost and the selling price. This is import type transactions. Example, this is export type transactions. Example, transfer pricing losses is not accepted by the law.